Hello everyone and welcome back to the podcast. I continue to study Netflix because I believe that the Netflix thesis, ever since the stock declined over 71% in June 2022, continues to illustrate for long-term investors the path to long-term wealth generation in the stock market. This is a fascinating case. If you're not aware of my past deep dives, I really recommend you go read them because there is so much to be learned here. So let's get deep into it. I remain fascinated by the rebound of Netflix stock from the June 2022 lows, with the stock now up 371% since. Netflix's 12 trailing month net income margin continues to trend up, as you can see in the graph below. Net income margin came in at 24% in Q3 2024, up from 17.64% in Q3 2022. As I explained in my Netflix re-deep dive, which I linked to in the written form of this update, this performance is largely due to Netflix's ability to exploit cultural asymmetries. Netflix is able to produce content at a marginal cost in over 60 countries, and if any piece goes viral, the reward is non-linear because the piece of content travels the world effortlessly, because indeed Netflix's subscribers, 600 million of them by the way right now, are located worldwide. Co-CEO Ted Sarando's remarks in the Q3 2024 earnings report continue pointing to this reality, which the company has been talking about for years now, but no one really paid attention when the stock declined 71%.
This year, we've maintained very healthy engagement, about 2 hours of viewing per member per day, and engagement on a per owner household is up through the first 3 quarters of 2024. So when we look forward into 2025 and beyond, we want to build on that success. We plan to build on that success. And we've been making original programming now for more than a decade, and the core has become very strong. We have a team of people who are the best creative talent around the world. We have a culture and an operating model that allows us to create stories in more than 50 countries and thrill audiences of more than 600 million people all over the world.
Rather subtly, Netflix's operations are more finely tuned than that of its competitors to produce and capture the aforementioned cultural asymmetries. This property has only showed up in the financials after the narrative that Netflix had lost its edge sent the stock down over 70% in the summer of 2022. Further, reviewing the Q3 2024 earnings report in depth continues to reveal no particular operational change versus 2022, as has been the case in previous updates. Netflix simply continues to be focused on acquiring more members and increasing engagement levels, as was the case in 2022. In the graph that you see on the screen now, you can see how spectacular the decline in the stock price, the blue line, was in late 2021. That was a 70% plus drop, and before this drop happened, the entire market thought that Netflix was completely indestructible as a company. This is the equivalent of seeing maybe something like Apple drop 70%. That was incredible. And you can see how the net margin trended down in tandem with the decline of the stock. And now you can see how the net margin, this is the orange line, is now trending way past the last all-time highs. As I explained in my latest Duolingo update, the absence of any particular drivers, coupled with notable outperformance, is the hallmark of organizational excellence. It tends to indicate that folks within the company are more obsessed with delighting end consumers than at other companies. And ultimately, the higher levels of consumer satisfaction equate to financial rewards down the line. What really fascinates me, however, about this case is that I was among the individuals in the summer of 2022 that could not see the superiority of Netflix's operational algorithm. I didn't own the stock, I didn't sell it or anything like that. I did a deep dive on this company at that point in time, and I couldn't see through the narrative myself. It was extremely hard to see that Netflix, being just a bit better in terms of producing and distributing content than its competitors, would lead to the financial outperformance we see now. It was even harder to see that without meaningfully changing its operational framework, Netflix would attain higher levels of capital efficiency than in 2020, when the whole world was glued to a screen and had nothing else to do. As you can see in the graph below, return on total capital for Netflix came in at 15.04% in Q3 Q3 2024, 14% higher than the previous peak in Q3 2021. So precisely because I couldn't see through this narrative at that point in time, I think that there's a huge lesson to be learned here. Despite the increased competition in 2022, Netflix's organizational properties had not degraded in any form. Netflix was as focused as it had ever been on delighting the end consumer. Although Netflix's widely acclaimed competitive position before 2022 was technically the result of being the first entrant in the streaming market, at a deeper level it was due to a superior focus on end consumers versus competitors in the broader entertainment space. The lesson to be learned is that so long as organizational properties remain intact, financial rewards likely await in the future. Or another way of saying this is that selling winners early is usually a big mistake. This is one of the main premises I teach in my Tech Stock Goldmine course, in which I've taught hundreds of students to date how to identify winners in the tech space early. Indeed, there is no guarantee that this equation will hold every single time, that excellent organizational properties in time equate into financial outperformance. But in my research, I have found that extraordinary organizational properties are indeed a very strong predictor of financial outperformance. Consider the graph below, in which you can see how Costco's return on total capital outpaced that of Walmart in the 2011 to 2016 period. As is the case with Netflix, there was no particular driver that led to this outperformance. It's Costco's superior focus on delivering value to customers at a lower real price over time that has equated into the inflection in total return on capital for the two companies, with Costco coming out ahead. This was largely unpredictable, as has been the resurgence of Netflix's financial performance, yet both are driven by the same intangible force. People go to work every day at these companies more obsessed than at other companies in terms of executing their operational algorithm, which in this case for Netflix is simply delighting end consumers more, and by the way for Costco it's just the same. This was as unpredictable as has been the resurgence of Netflix's financial outperformance, yet both are driven by the same intangible force, which is people going to work every day more obsessed with delighting end consumers than at other companies. On January 2022, I wrote my Amazon deep dive with the stock down nearly 50% from its previous highs. In this case, I did understand Amazon's operational algorithm in depth, and this enabled me to foresee that the company's ability to deploy capital was untarnished at the time. Indeed, much of the decline in the free cash flow per share levels that you can see in the graph below, the orange line, was due to Amazon stepping up its capex to effectively double the size of its fulfillment network. In the deep dive, I ultimately explained that per Amazon's undeteriorated organizational properties, free cash flow per share was set to reach new highs, and that therefore the stock price will likely track along. As you can see in the graph below, free cash flow per share has exceeded the pre-2022 highs, as I quote-unquote predicted, and the stock is up 116% since I wrote my deep dive. Similar to Netflix and Costco, this was unforeseeable by any traditional quantitative means, yet the superior focus on delighting end consumers has also equated to improved financials down the line in this case. These students of my Tech Stock Goldmine course come out of their learning experience with a rich understanding of how to evaluate organizational properties over time and tell the losers apart from the winners. Yet it ultimately comes down to whether management teams do what they said they will do or not. For now, Netflix co-CEO Greg Peters said the following about the company's focus on end consumers.
Just jumping on that, we've always been focused on trying to constantly improve every aspect of our service. It served us quite well for the last decade and a half. We hope and expect it'll serve us well for decades to come. And the question, I mentioned priorities too, and our top priority is really bringing that mindset to improving our core film and series offering.
It thus seems that Netflix is now looking to embed its operational algorithm deeper into its content production efforts. So long as management then executes as they say they will do, the odds of Netflix enhancing its earning power over time are high. Simultaneously, Netflix is now deploying its operational algorithm across 3 new lines of operations: games, live content, and its advertising business. I believe that the odds of Netflix multiplying its earning power over the coming decade by enhancing and channeling its algorithm into these endeavors are also high. When asked in the Q3 2024 earnings call when advertising was going to evolve into a major revenue source, Netflix co-CEO Greg Peters answered by elegantly depicting the opportunity that lies ahead for Netflix.
So it starts to become a material contributor of revenue over the next several years. But if you step back and you think about this opportunity ahead of us, over $600 billion in consumer spend in the areas and countries that we operate, we're only capturing roughly 6 to 7% of that today. That's tremendous upside if we can just stay focused on that continuous improvement and drive to that future.
Thus, the second main lesson to be learned from the Netflix case is that the losses from selling a winner early tend to compound over time. With no cultural or operational degradation in sight, it seems that Netflix is perfectly set up to capture on the above opportunity. As a result, the size of the total mistake for those that sold at the June 2022 lows is likely to get much bigger from here. Additionally, since in the modern economy, a small minority of picks increasingly tend to yield a majority of the returns, such a mistake could render a portfolio uncompetitive over the long term, because Netflix could have been the pick that actually makes your portfolio work over decades. Additionally, both the Netflix and Amazon cases illustrate something really important, that the ultimate test of a company's culture and thus of its operational algorithm is its succession engine. So the mechanism via which the company allows new leaders to bubble to the top. The dramatic declines of both Netflix and Amazon stocks in the second half of 2022 was aided by their respective co-founder and CEOs at the time, Reed Hastings and Jeff Bezos, stepping down, with individuals from within the company stepping up. And the market didn't really know what to think about these guys stepping up to the job. In both cases, the new CEOs are folks that have spent decades at the company soaking up the culture and deeply understanding the way the company in question works. As a result, they have now turned out to be capable custodians of their respective corporate cultures, and strong financials have ensued. Not surprisingly, this is also the case with Costco. Costco has been led by two CEOs following the departure of co-founder Jim Sinegal in 2012, and both have continued to lead the company well. The remarks of current Costco CEO Ron Vacris during the Q4 fiscal year 2024 call reveal how he also places great emphasis on looking after the succession engine, which is one of Costco's secrets for long-term success.
Succession planning continues to be a key focal point for us as we're continually working on identifying the future leaders of our company. In fiscal year 24, we promoted 95 new warehouse managers. 85% of those promoted started at Costco as an hourly employee. This promote from within culture and the long-term career it helps to build is core to who we are as a company, community member, and retailer.
Okay, everyone, that's it for today. I hope that you enjoyed this Netflix update. I am now working on my Chegg deep dive. This is a company which apparently ChatGPT has killed, but I'm diving deep into it to find whether it's true. If it's not true, it's likely to be an investment opportunity. If it is, I think there will be a lot to be learned, especially for prospective and current Duolingo shareholders, since Chegg is an education company. And so this is very much up my alley in terms of the Duolingo thesis and so forth. So again, as always, can you please share this with one friend whom you think will enjoy it? These deep dives are for free, and so the only way this grows is with your help. So thank you very much, take care, and until next time.